Everyone's relieved that the rate of inflation is finally starting to fall. However, it might be too soon to declare victory. And this is because the cost of energy, which is one of the prime drivers of inflation, is starting to tick upwards. So in this video, we look at the reasons behind that, but we also consider its consequences and what we can do about it as investors. This video is sponsored by Koifin, which is a provider of live market data for investors, but also powerful analytical tools. So let's look at how oil is fueling inflation fears in a bit more detail. So here in the bottom panel, you can see the rate of inflation in the US going back to the late 1960s. And you can see how it is linked to the rate of increase in the price of oil. So that's in the middle panel, and the actual price of oil is in the top panel. Now, the worrying precedent from the past is the double spike in inflation which the US suffered in the late 70s and early 80s. And that was very much driven by the price of oil. So you can see this huge spike in the price of oil in 1974 and a second spike which began in 1979. And then with a slight lag, you can see the increase in the rate of US inflation, which peaked at about 12.2% in 74 and then about 15% in 1980. If we zoom in to more recent data, you can see the huge surge in the price of crude oil in 2021, but also the surge that we got in inflation around the same time, slightly later in fact. Now, a big driver of the fall in inflation has been that fall in energy prices. So in the US at the moment, oil has gone into deflation. It's falling year on year, and that's pulled down the headline rate of inflation. Now, the price of oil is notoriously difficult to forecast because it depends on things like geopolitical instability in the Middle East in particular, but also things like supply and demand fluctuations. Mostly, it has to be said, supply fluctuations. So if we look at the price of oil, the real price of oil, this is inflation adjusted, going back all the way to 1960, that's the graph you can see beside me here. What I've done is I've annotated particular events in the past to see how they affected the price of oil. And the really big movers have been things like the Yom Kippur War. So that created the spike in energy that we saw previously in 1973. And that caused a big US inflation spike because of the oil embargoes which followed. Then in 1979, we had the Iranian Revolution, and that also triggered a spike in the price of oil and another inflation spike in the US and elsewhere. More recently, the spike in energy prices was in part caused because of Russia's invasion of Ukraine and the sanctions which followed. So none of these are very predictable events. They're driven by human behavior, and strategists, oil analysts just can't forecast when they'll happen. So what are the reasons behind the current increase in the price of energy? Now, just to give you a feeling for the size of global oil production and which countries control a lot of that supply, it's dominated by two organizations, which are groupings of countries. And that's OPEC, which is dominated by Saudi Arabia. That produces about 10 million barrels a day, 10% of the global supply. And we also have OPEC Plus, which is dominated by Russia, which also produces about 10 million barrels a day. And you can see that between these two organizations, they control about half of the global supply. So when they decide to cut production, it has a massive effect on the oil prices around the world. Now, I said it's difficult to forecast the price of oil, but it is driven by supply and demand. So at the moment, what we're seeing is an increase in demand. And that's driven by the fact that we're traveling more. We're also having more economic activity. And really, at the moment, it's still the case that almost any economic activity will increase the demand for oil. Renewables are growing, but not quickly enough to take away that linkage between growth and oil demand. And looking at this data from the US Energy Information Administration, you can see that demand and supply, according to their forecast, is going to grow to record levels. However, supplies are going to be restricted and demand will continue to grow according to them. And that means we're going to be in a tight situation when it comes to oil inventories. And that's probably going to put upward pressure on prices. At the same time as we're seeing higher demand, we're also seeing supply cuts from OPEC and OPEC Plus. Now, Saudi Arabia said this year that it was going to cut its supply by 1 million barrels per day. And it looks as if Russia is going to go along with that supply cut. So these are two of the biggest producers globally, and that has definitely pushed up energy prices. They've also announced that they're going to roll over these supply cuts into the end of 2024. It also seems to be a goal for Saudi Arabia, but also OPEC and OPEC Plus, to raise the price of oil to $100 a barrel. Currently, we're at just over $80 a barrel, so that would be a roughly 20% increase. Now, of course, energy is not the only driver of prices. A really important driver in developed markets is the cost of services, which in turn is driven by wage inflation. So if we look at wage growth in the UK, that's the top panel you can see here, and the US, that's the bottom panel, you can see it's well above the rate of growth that we had before the pandemic. So in the UK, we're seeing wage growth of 8.1%. That was the most recent data. And in the US, we're looking at 4.3%. That's not as high as the UK by any means, but that's well above rates before the pandemic, where we would expect something like 3.5% wage growth in the US. So another driver of high inflation is the tight labour market that we see in developed markets. And probably the only way which that tight labour market will ease is by having higher unemployment, which often goes hand in hand with a recession. Now in this video, we're going to use Koifin to look at economic data, but also market data. And it's incredibly useful as an investor to get a window on markets and economies globally. Now, PensionCraft users get a special discount from Koifin where you get 15% off your subscription, but you have to use the link in the description below. If energy prices do increase, as many people expect, what will the consequences be? Well, there is a direct effect on inflation, certainly for headline inflation, which doesn't strip out energy prices. And that can be very severe, as happened in that double peak that we saw previously in the late 70s and early 80s. Now, in that period, the price of oil in the United States went from about $3 a barrel and it went up about tenfold. So these energy squeezes can be very extreme, and you can get a very big increase in the price without a very large cut in the supply. That's particularly true at the moment because many energy companies have been underinvesting in new supply, and that's because of the shift to green energy. Now, there has been some increase in the infrastructure that goes into producing oil, but also exploring for oil. But really, that's been limited by the fact that oil is on the way out. And in turn, what that means is that if there is a cut in supply, then that can have potentially a very large impact on the price of oil. And in case you were wondering, the UK was also severely affected by the increasing cost of energy. So if we look at inflation in the UK, at the same time as we saw that double peak in the US, there was also a double peak in the UK. In fact, the first peak was bigger than the second here, and inflation in the UK peaked at not much short of 30% per year. And it's not a coincidence that there were also recessions in the UK at these times as well. Those are the grey vertical bars which you can see on this graph. Now, central banks focus on something called core inflation when you strip out food and energy prices. And that's because those are much more volatile, those components, and also can't really be affected by the central bank's monetary policy. They're so-called exogenous factors. Raising interest rates will not lower the price of oil. However, the effect of higher energy costs can spill out into almost all prices. And to look at an example of that, let's consider the price of a loaf of bread. So we start off with higher energy prices, and then what we see is that farmers also have to pay higher energy costs. And of course, farming wheat, for example, is very energy intensive. You need to move a lot of stuff around. You have to plow fields, you have to sow seeds, and you have to harvest. All of those will be more expensive for the farmer, and he'll pass on those costs to you. Also, fertilizer, which is used to increase yields of crops, also depends on energy. Fertilizer production is a very energy intensive process. So higher energy costs also feed through to higher fertilizer costs, and that again feeds through to higher costs for the farmer and to you. And this is just one example, which is an agricultural example, but any manufacturing process could be affected in a similar way. In fact, there was a really nice article about this from the St. Louis Fed, and the title of the article was, "Does Oil Drive Inflation?" And what they did was to look at the year-on-year increase in the price of oil versus the year-on-year increase in producer prices. These are factory gate prices. and also consumer price inflation. This is our consumption basket for a typical US citizen. And what's really interesting is that producer prices have a very high correlation with oil. And that's because manufacturing processes in many cases depend on oil. And in contrast to that, CPI inflation, the consumer price inflation, had a much lower correlation to oil. And that's because the size of energy in the consumption basket of a typical US citizen is not that large. The consumption basket in the US is much more driven by service consumption. So whereas PPI inflation had a correlation of about 70% to the price of oil, CPI inflation only had a correlation of around 30%. Now the US is much closer to self-sufficiency for energy, for fossil fuel energy supplies, than Europe. And last winter, Europe was left struggling to replace its supply of Russian gas with alternatives from the US and elsewhere. So while there has been refilling of reserves in Europe in order to prepare for the winter, it's still the case that if supplies of liquefied natural gas are somehow disrupted, it's going to push up the price of European liquefied natural gas. And this story about a strike in Australia from one of these LNG suppliers showed how sensitive European gas prices were. There was a surge in European natural gas futures prices as a result of this strike. And in the UK, we all remember what happened to energy prices when gas prices spiked. The government stepped in to try and mitigate the increasing bills that we had to pay, which in many cases had doubled. So the schemes were called the Energy Price Guarantee, and there was also the Energy Bills Support Scheme that ran from October in 2022 until March of this year. However, I suspect this time around, the government's going to be less generous when it comes to handouts if there's another gas price squeeze. So what does this mean for investors, and what can we do about this? Well, if we do get another spike in energy prices and inflation does broaden out into things other than energy, then the central banks aren't going to have a lot of choice. They're going to have to raise interest rates, or at least keep them at a high level for longer. Now that has a direct impact on investments, in particular the style of investments which do well. Now the two styles which are particularly affected are growth stocks, which of course have been the huge US success story over the last 10 years, and value stocks, which have underperformed over the last 10 years. Growth stocks aggressively grow their earnings, and tech companies have done that very successfully. Value stocks are reasonably priced stocks, which historically have outperformed very well, and this is of course Warren Buffett's investment style. However, they've disappointed recently. But these two styles of investments are themselves driven by monetary policy, as we've seen recently. To illustrate that, let's look at the US Federal Reserve's policy rate. So that's in this top panel, and this graph ranges from 2004 up to the current day. And as I make this video, the current policy rate is 5.5% in the United States, and that's in September 2023. In the bottom panel, what you can see is the performance of two ETFs. The first one is IVW, and that's the iShares Growth ETF. And what I've shown here is the outperformance relative to the S&P 500. So if growth outperforms, this IVW line will go upwards. And that's exactly what we saw recently with the zero interest rates after the pandemic. So here you can see at the end of February 2020, rates were cut to zero again. And then we started to see this massive outperformance of growth relative to value, which was hugely underperforming the S&P 500. But then when the Federal Reserve started to talk about raising interest rates again, this started to reverse. So growth started to underperform, and we saw the tech wreck, and value started to outperform. You can see this line starting to go upwards. But then if we zoom in again to this year, what we now see is a renaissance of the growth story, and that's fueled very much by the AI narrative. These mega cap 8 tech stocks in the US, which dominate US markets, have been propelled upwards by expectations that AI will push earnings ever higher, and that narrative shows no signs of fizzling out yet. However, if those companies do disappoint with their earnings, they don't meet up to these incredible expectations, And also, if we get this energy spike followed by an inflation spike, followed by monetary policy, which is tighter for longer, what I'd expect to see would be that value would once more outperform and growth would underperform. If you think that's what's going to happen, another way to look at this is via sectors in the United States. Unfortunately, there are several sector funds which you can buy both in the UK and the US, such that you could implement these beliefs. So here I've shown two sectors, the tech sector in the US via the XLK ETF. That's the top line which you can see here, which I've highlighted. I also show the S&P tracker, SPY. That's the broad market performance. And then finally the energy sector via the XLE ETF. So let's zoom into the period after the pandemic sell-off. Energy was very severely and negatively impacted by that fall in activity during the pandemic and during the lockdowns that followed. It fell much more than the S&P and it fell much more than tech. But as is often the case, after one of these crises, the thing which sells off the most recovers the most. So if our starting point is that post-pandemic trough, notice how energy is now the outperformer. It's outperformed tech since the beginning of this period, just at the trough of the sell-off in 2020. So if you are going to play this via the XLE ETF, the drawback is that it hasn't really sold off. It hasn't pulled back at all. It's currently at very high levels. But if we do get another energy surge, what I'd expect is that it would go even further. So I think the consequences of a secondary spike in inflation triggered by higher energy prices would be a monetary policy response. And secondly, I think we'd get value outperforming relative to growth. And then if we look at sectors, what I'd expect is that energy would do well. Now, of course, the UK market, again, was one that did very well in the aftermath of the tech wreck. And that's because it contains lots of energy stocks and lots of high income stocks, which tend to perform well in that kind of environment. So maybe another consequence of this would be that the UK market, which is currently undervalued, would also shine. Now, of course, this isn't a prediction. I don't make predictions, but hopefully I've helped you craft your own narrative about whether you think energy is going to spike again, inflation will surge again, and what you might think about doing as a consequence. Now, don't forget our offer from Koifin. You get a 15% discount on your subscription if you use the link in the description below. And, as always, thank you for listening.